Thank you for joining us. This is Business Incorporated coming to you live from Lagos, Nigeria. I'm Chimeze Obi Iwago. On the program today, South Africa's watchdog denies withdrawing FX rigging charges against some banks. The African Export-Import Bank begins its 24th annual general meeting of shareholders in Kigali, Rwanda. Plus, Ghana asks IMF to extend aid deal and more money expected to be sorted. Let's get started now, beginning with the markets here in Africa. Of course, all the markets are open today after the long holiday to mark the Muslim Eid al-Fitr. Here in Nigeria, the market started the week positive after heavy losses last week. At intraday, the NSE All-Share Index was trading high at 0.17%. The market in South Africa was also up 0.03%. South Africa's competition watchdog has denied withdrawing charges against some of the 14 banks accused of rigging the rand currency. The commission is seeking to impose fines on more than a dozen local and foreign banks that it alleges colluded to coordinate trading in the rand and the US dollars. And of course, the Egyptian market was up 0.23%. In Kenya, the Nairobi Stock Exchange traded up 0.63% on Tuesday. In the Middle East, just the markets in the UAE, Abu Dhabi and Dubai financial markets are open for trading today, with some major Gulf markets still on Eid al-Fitr holidays. In an otherwise quiet region, Abu Dhabi was up 0.41%, while Dubai dropped 0.68% at intraday. Well, for Qatar Stock Exchange and Saudi Stock Exchange, they are closed, still on holiday for the Eid al-Fitr holiday. Qatar closed on Thursday, high 2.88%, while Saudi Arabia closed 1.24% higher. In Europe, bourses there were lower during mid-morning trade as technology stocks slumped after weakness seen on Wall Street in the previous session. Europe's technology sector led the losses as jitters hit the market. Well, my colleague in Frankfurt, Conrad Bussen, has the details of those. Hello, Conrad. Good afternoon. Thank you very much for joining us.
Hey, Timmy. Good afternoon from Frankfurt.
Right. Another global cyber attacks have hit companies again. How is the market reacting to this? Is it just the technology stocks that are affected?
Well, you know, the cyber attack hit many different companies from many different sectors. You know, a Russian gas and oil producer, a German consumer goods maker, a French bank, you name it. So this cyber attack, of course, not only made many companies nervous, but also investors for many different kinds of stock. But you're right, the sell-off in tech stocks is the most significant today. The reason behind this is, of course, nervousness in terms of the cyber attack, but also, you know, the record fine by the EU Commission against Google. Some of those business models in the tech sector might not work as smoothly and easily as investors had thought up until now.
Just looking behind you, I can see that the DAX is already up at this hour, even though it was tilting down at mid-morning. Just wondering what's driving it at this moment. But then the European Central Bank President Mario Draghi has hinted the ECB could be prepared to scale back its monetary policy amid improving economic prospects in Europe. Is this a piece of news investors at the markets want to hear?
Not really, Chimmy. You know, those statements by Mario Draghi had a direct impact on the euro-dollar exchange rate, and the up and down of the euro-dollar exchange rate is basically what's driving the stock market today. Let me give you the details. The speculation that eventually the European Central Bank might cut back its super loose money supply caused the euro to jump to the highest level in more than a year, up to nearly $1.14 this morning. And this was what was weighing on the stock market in early trading, mostly here, at least on the DAX here today, because of course German exporters don't like it when the euro becomes too expensive in relation to the dollar. Then during this afternoon, only about 20 minutes ago, the ECB came out with not official statements, but news agencies quote European Central Bank monetary policy makers of saying, well, the statements by Mario Draghi should not be misunderstood. Of course, the monetary policy remains where it is, at least for now, etc., etc. And all this made the euro go down again, come down from those super high levels. That's good news for German exporters, and that's good news for the DAX. That's why you see that slump here, that jump here upwards of the German share index.
Interesting, Conrad. Now let's look at the Bank of England's latest biennial financial stability report that was published, that was yesterday, Tuesday. What is in that report?
Well, the most important piece of news in that report is that the Bank of England is concerned about lending in the UK. You know, the number of loans that British households have, you know, the number of credit card debt, the amount of credit card debt has risen quite significantly recently, and this is a concern for the monetary policymakers, for the financial stability people at the Bank of England, and that's why they require the banks in the UK to provide higher capital buffers. This discussion is, of course, strongly related to the discussion about interest rates in the UK. The minutes of the recent meeting of the monetary policy makers in the UK shows that, unlike, Mark Carney's, he's the Bank of England's chief, clear statement that due to Brexit this is not the time to raise interest rates, there are members of the Monetary Policy Committee in London who think that this is the time to raise interest rates. As you know, the consumer price inflation in the UK is at nearly 3%. And of course this also has to do with the high amount of lending in the UK. If you want people not to take on too many risky loans, you have to make credit more expensive, and that's what you do when you raise interest rates.
All right, thank you very much, Conrad. I have to let you go at this time. Of course, it's a wet day here. I don't know what it looks like out there where you are, but enjoy the rest of the day.